Stop scrolling. Bitcoin just sent a signal the entire market is misreading. While the headlines focus on a 50% crash from $126,000, the biggest buyers in global finance have quietly started accumulating again. So what does this mean for your Bitcoin if institutions are buying during the fear? By the end of this video, you will understand the hidden mechanism that is quietly funneling billions of dollars into this market. You will see the hard data that reveals who is accumulating during this period of fear, and you will understand why this cycle is fundamentally different from all others. The headlines are not the story. The real story is the signal that has just been given. First, let's orient ourselves to the current environment, because the fear in the market is rational. Bitcoin reached a peak of $126,198 on October 6, 2025. As of early March 2026, the market has been bleeding out in a slow, grinding correction, trapped in a range between $60,000 and $72,000. For anyone who entered the market in late 2025, this 46% drawdown is painful. On a technical level, the chart looks weak. Every rally attempt has been aggressively sold off, creating a vortex of fear. This price action is happening inside a difficult macroeconomic environment. The Federal Reserve has held interest rates in the 3.5% to 3.75% range, keeping pressure on risk assets. At the same time, rising geopolitical tensions between the US and Iran have pushed some capital toward the perceived safety of gold, challenging Bitcoin's digital gold narrative in the short term. The result is predictable. Short-term investors panic. Retail capitulates. They sell to stop the pain. But this is only one side of the ledger. While one group sells in a panic, a completely different class of market participant is systematically doing the exact opposite. And the divergence between these two groups is the most important signal in global finance today. While retail sentiment is at a historic low, the world's largest financial institutions are viewing this period of consolidation as a strategic buying opportunity. This isn't a theory, it is a measurable flow of capital. The primary channel for this institutional money is the fleet of spot Bitcoin ETFs, approved in the US in 2024. While these funds did see periods of outflows that contributed to recent price weakness, that trend has now reversed. In the final days of February and the first week of March 2026, we witnessed consecutive days of major positive inflows. This data suggests the wave of panic selling is becoming exhausted, and a new, stronger set of hands has begun to absorb every coin that becomes available. Leading this charge is BlackRock, the world's largest asset manager. Their iShares Bitcoin Trust, IBIT, alongside Fidelity's fund, has become a dominant force in the market, creating a new, persistent, and largely price-insensitive source of demand. Think about what that means structurally. For the first time in Bitcoin's history, there is now a permanent institutional pipeline for capital to enter the market. Every financial advisor, every retirement portfolio, every institutional mandate that decides to allocate even 1% to Bitcoin must go through this same system. That pipeline did not exist 5 years ago. Now it does. This isn't just an ETF story, however. We're also seeing this conviction from corporate treasuries. Strategy Inc., formerly known as MicroStrategy, has continued its aggressive strategy of acquiring Bitcoin for its balance sheet, consistently using market dips to add to its colossal position. Retail sees a crash. Institutions see a 46% discount. They are not shaken out by volatility. They are designed to use it. So let's pause for a moment. If the price has fallen nearly 50%, but institutions are absorbing supply at the same time, what does that actually mean for your long-term Bitcoin position? This institutional accumulation is not random. It is a calculated response to a fundamental change in the mechanics of the Bitcoin market. It is happening for three primary reasons. First, institutional capital operates on a different time horizon. A firm like BlackRock is not making a quarterly trade. They are making a strategic allocation for the next decade. Short-term price fluctuations are irrelevant. Their thesis is built on Bitcoin's long-term adoption as a global store of value. For them, acquiring Bitcoin in the $60,000, $70,000 range is a foundational opportunity to build a generational position. They are not buying a price chart, they are buying the asset. Second, this new institutional demand is colliding with the biggest supply shock in Bitcoin's history. The halving, which occurred in April 2024, is an immutable feature of the network's code. It algorithmically cut the amount of new Bitcoin created each day in half. Since the 2024 halving, new Bitcoin supply entering the market dropped to roughly 450 coins per day. So what does this mean for your Bitcoin if this demand keeps building while supply keeps shrinking? For the first time ever, we have a post-halving environment where this dramatically reduced supply is meeting a tidal wave of new, regulated, institutional-grade demand. This is the simple law of supply and demand, playing out on a multi-trillion-dollar scale. Third, this cycle is structurally different because of the regulatory wrapper. If you follow this channel, you already know something most investors miss. The price is not the story. The plumbing of the financial system is the story. The spot ETFs are a permanent, regulated, and insured bridge connecting the traditional financial system, with its trillions in managed assets, to the Bitcoin network. This has never existed before. This low-friction pathway allows financial advisors and wealth managers to begin allocating a small percentage of their clients' portfolios to Bitcoin, a process that has only just begun. So, what is the signal? The signal is the sound of two monumental forces colliding. A new, structural, and persistent institutional demand running headfirst into a mathematically guaranteed diminishing supply. Let's clarify the mechanism. BlackRock and Fidelity are not just making speculative bets. For the most part, they are agents, fulfilling buy orders on behalf of their clients. As financial advisors across the country formally recommend a 1%, 2%, or 3% allocation to Bitcoin, it generates a steady, non-stop flow of capital into these ETF products. This demand is price insensitive. It is not driven by fear or greed. It is driven by a portfolio allocation model. This creates a constant underlying buy pressure that is completely new to this market. It acts as a gravitational force, establishing a floor of demand defended not by traders on social media, but by billions of dollars in automated, long-term capital flows. This slow, relentless accumulation by the quiet giants of finance is the signal. With their actions, they are telling you that they view this period of consolidation not as a crisis, but as a foundational buying opportunity. They are absorbing the coins that fearful investors are selling, convinced that these same assets will be worth multiples of their current value in the years to come. The prevailing narrative is focused on the sellers, the price drop, and the fear of further decline. But the decisive, market-defining signal is coming from the buyers. Institutions are not just participating in this market, they are fundamentally rewiring its structure. We are witnessing, in real time, the transition of Bitcoin from a primarily retail-driven speculative asset to an institutional-grade financial asset. The old playbook of 80% boom and bust cycles is being challenged by this new, stabilizing force of institutional allocation. Understanding this mechanism is the key to navigating what comes next. The volatility is not the risk. It is the condition that allows for this great transfer of assets from the impatient to the patient. If you want to continue tracking the capital flows and the signals that truly matter, make sure you are subscribed with notifications on. The institutions have revealed their long-term strategy. The signal has been given. Every cycle in Bitcoin ends the same way. Demand suddenly overwhelms available supply. And when that happens, the price doesn't rise slowly. It reprices violently. That is the event horizon we are now watching for.